How does deflation affect your wealth and assets? Have you ever thought about how the value of money changes over time? Let's take a closer look at deflation and its effects on your wealth and assets. Deflation is when prices across the economy decline. This means that the real value of money increases, but the nominal prices of most assets drop. This situation has mixed effects on your financial situation, depending on what you own. When deflation occurs, cash and liquid assets become more valuable. Each dollar can buy more goods and services. This is great news for savers and those holding cash, as their purchasing power rises. Imagine having a dollar that can now buy more than it could before. That is a win for anyone with cash in hand. On the flip side, illiquid assets like real estate and stocks often lose value during deflation. As prices drop, the market value of these assets declines. This can lead to a decrease in wealth for those who own them. If you have invested in property or stocks, you might see your investments shrink in value. For people or businesses with debt, deflation can make things tougher. The amount owed does not decrease, but the value of money rises. This means that paying back loans becomes more expensive in real terms. Essentially, wealth shifts from borrowers to lenders, which can create financial strain for those in debt. Historically, deflation has been linked to economic downturns, like during the Great Depression. Falling prices led to reduced demand, lower production, and wage cuts. This cycle can create a deflationary spiral, causing widespread defaults and unemployment. However, not all deflation is harmful. In the late 19th century, deflation was sometimes caused by increased productivity. In those cases, it reflected improvements in goods and services rather than a collapse in demand. From a financial history perspective, the impact of deflation on wealth and assets is closely related to asset prices and debt levels. When asset prices fall, it can weaken economic growth. This was particularly evident during the Great Depression, when deflation and falling asset prices combined to create a massive economic contraction. During deflationary periods, holding cash or liquid assets can help protect and even increase real wealth. On the other hand, owning illiquid assets like property and stocks can lead to nominal losses. Economic uncertainty can also reduce investment and spending, which further depresses asset prices. Understanding these effects is important. Monetary and fiscal policies often aim to prevent deflation or counteract it quickly. This is because deflation changes how people think about spending, saving, borrowing, and investing. These shifts can shape wealth and asset values over time.